You're listening to New Retirement Radio, brought to you by the team at Prout Financial Design.
Hello, I'm your host, Certified Financial Planner, Dennis Prout.
I'm Heidi Cartwright, Financial Advisor and RICP.
Advisors associated with Prout Financial Design may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of Integrated Partners, a registered investment advisor, or 2. Solely investment advisor representatives of Integrated Partners, a registered investment advisor and not affiliated with LPL Financial. Investment advice offered through Integrated Partners, a registered investment advisor. Integrated Partners and Prout Financial Design are separate entities from LPL Financial. Dennis Prout and Nathan Prout are solely investment advisor representatives of Integrated Partners and are not affiliated with LPL Financial. The opinions voiced in this show program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriately qualified professional before making a decision.
WTCM News Talk 580. A good morning. It's time for New Retirement Radio with Prout Financial Design. Joining us in the studio today, Mr. Dennis Prout. Good morning, sir.
Good morning, Ron. Man, it is great to be with you on Thursday, June 25, 2026, 6/25/26. Man, and if you are listening to the rebroadcast, that is a rebroadcast on Saturday at a little after 9 a.m. And Ron, so good to hear your voice again. Here we are, all acclimating to this space, as are you. Yes.
Reacclimating here.
Yes. It's good to have you with us, Ron.
Thank you. Good to be here.
Thank you. And if you do have a question of a financial nature, either text us or write us at, or text us or write us, or call us. Thank you. Text or call, and how would they do that there, Ron? Please.
If you would like to text us or call us, it's one number, same number, 231-947-0023. If you'd like to write us, we won't answer that question for another couple of weeks, probably.
I was actually thinking
The mail is
Textus
slow.
Receptus, but yeah. And then you hear her voice, Heidi Cartwright, our own RICP and Executive Director. Good morning, Heidi.
Good morning to everyone. It's my pleasure to be here today, and this is our last show in June. I can hardly believe it.
Yeah. And
that's amazing.
It feels like, I don't know, March. The weather.
Yeah, the weather's been slow to warm. Although I did walk out this morning on my way to the walk, and I just went, oh my gosh. I just paused for a moment. Man, this is actually kind of warm. It was wet, of course, humid, but warmish. And hey there, next to me on my left, Nathan Prout, our Master Lead Advisor and Managing Director.
That's right. Good morning. It's great to be here.
That's great to have you. And over there,
Yes.
Beth Shire, our Marketing Director. Hello. In the former Colleen spot.
Yes. Thank you. Good morning. It's great to be here. And earlier this morning with the rain falling, I wanted nothing more than to stay in bed snuggled up. But now that the sun's out, it's nice and I'm feeling energized.
A nice greeting to walk out of the office for sure.
For sure.
Well, we are excited. It's the world that we live in is, I bet I've said, the same thing 3 or 4 times in the last week. We're on a wave in the markets right now and in the world that is, it's, I don't know that it's a mind blower, but it's something close to it. What's happening worldwide, globally, is just incredible. The change, now, not everybody's happy with all of this, what's going on. It was per usual, but some of the interesting pieces that are going on out there, I thought this was well worth reading. It's today's news, given the price of oil now is the same as it was before the war started with, what country was it anyway, Iran? It's the same, about $70 a barrel. Who would have thought? Literally not even a week into this. And the talking heads, it's always easy. Hindsight's always 20/20. But who would have thought? 2 weeks ago, they were on, I'll just say, a conservative business show, can we say Maria Bartiromo? Thank you very much. Saying, well, they were hedging 2 weeks ago. Well, how long will it take for things to get back to normal? Well, the price, what would you say? Maybe 3 to 6 months, and they didn't want to state anything out of sorts, if you will, and make people surprised. But who would have thought? Now, obviously, it can go back up at any point in time. But the fact that it's drifted back down to its pre-war levels, Javier Baez is one of my favorite energy analysts, as our own economist said. And I'm going to read exactly what he said here because he was right on. And it's so prescient, I thought it was well worth reading. When the day comes, the reopening, now he said this, by the way, on 6/6, so we can say, okay, 3 weeks ago, approximately. He says, when the day comes, the reopening of the Strait of Hormuz will be an extraordinary event. No kidding. Restarting about 10,000 oil wells. I thought that was interesting just in terms of the sheer number. Pumping roughly 15% of the world's production that had been shut down for 100 days and counting. Nothing even remotely close has been attempted. Ever. Ever. So the oil industry doesn't have a playbook for it. It will learn by doing. Unsurprisingly, the commodity market is deeply divided about how long it would take. Deeply divided. Oil bears, the ones who think it's going to take forever, believe it. Oh, it's not. The ones who are short term. So this is exactly opposite of what you might think. Believe it could be done in days and weeks. While the bulls talk about 6 to 8 months, perhaps even a year for the price to get back to normal. The most pessimistic say many wells won't restart at all. That's still a possibility, I guess, if they've been shut in and they can't revive them. I guess it takes really some resuscitation.
Yeah.
My industry soundings are far more upbeat. When it happens, he says, Javier, it would start as a trickle, but very quickly, in weeks if not days, transform into an oil flood. I'm on the side of the oil price bears, as you may have guessed, he says. So, which means he thought the price would come down almost immediately.
An article in the Detroit News yesterday, which would be, Wednesday the 24th?
Yes. Today is Thursday the 25th.
They quote Patrick DeHaan, who's with Gas Buddy. He's an analyst for gas and oil prices, says, we should see gas prices falling in Michigan starting in the next day or two, and he said that yesterday, and probably right through July 4th, prices should decline.
Exactly opposite
Excellent.
of what one might think.
I'll wait to get my gas.
Darling, we should take the station wagon and take the children with us this time. Or whatever. Just to make sure you're listening, right? Well, we have so much to talk about today. Heidi's going to be talking about the 3 themes for the second half of 26.
Yes.
The 3 themes. Nathan's going to be talking about
Trump accounts.
Thank you.
Yep.
Trump accounts. Now, you can close your ears if you want to at the name. Not everybody's that positive about such things, but you know how that goes. So donor advised funds, I'm talking about donor advised funds and qualified charitable distributions. Which is better for charitable giving in retirement? If you're retired and or even looking toward retirement, and or if you have appreciated assets, whether it's mutual funds, a piece of property, the donor advised fund may be the way to go in terms of getting extra deductions. Both can help you support causes you care about while potentially reducing taxes, but they work very differently. The best choice depends on your financial situation and your charitable goals, and frankly, what your financial advisor and or accountant might tell you and or advise you to do. Well, frankly, you've got this XYZ mutual fund, sample conversation perhaps over here, that went from 10 to 20,000. Let's just keep it simple, shall we? Okay. It went to 20,000 and you say, I'd love to help my church or organization with that new building they just bought with that $20,000. But yet, I don't want to sell it, take the cash, and then give it to the organization because I can't itemize or deduct it anyway. because it's only 20. Well, it's 20,000, not chump change, but it's only 20,000 when the amount of that I can deduct as someone being over the age of 65 is about what, Nathan? A couple.
Yeah, assuming they're using the standard deduction, it's close to 45,000 with the $6,000 senior bonus per person through 2028.
Oh, to be a senior, Ron.
Yeah.
Mm-hmm.
That's almost better than the McDonald's coffee deal right there.
Yeah.
So with that high deductible, that is not an inducement then for some people to donate to charity because they can't itemize, right?
Right, but if you do want an inducement anyway, think about this. We could gift that property to that organization and not pay any tax on the gain. Not pay the tax on the gain and do all the rigmarole of that, and then gift it over a period. You could do it immediately if you wanted to, and or over a period of years. And if it was bigger, let's say a bigger amount, say $50,000, then you could itemize. You could choose to itemize, Heidi.
Yes. And this year there is something going into effect from the One Big Beautiful Bill Act that we've talked about before on the show
Oh,
about charitable deductions.
Yes. Taxpayers taking the standard deduction will now be able to make deductible charitable contributions up to $1,000 for individuals and $2,000 for MFJs, married filing jointly.
MFJs.
So, there are some slivers of hope. Yeah, hope and change. It's always turned down to politics.
But in your practice, you run into people that have probably nice portfolios, and they say, we want to give some, as you said, to our favorite organization, our church or charity or nonprofit, and they don't just write a check, right?
I can't hear you very well, Ron.
I don't know why that is. I've got my mic on super duper loud here.
Okay.
But anyway, they don't just write a check. You're talking about the options where they can benefit tax-wise.
Yes. And as you say, as you're talking, I was thinking they could use that to leverage what they want to do elsewhere as well. So let's say that's not yet 50% of their, let's see, the deductible amount for gifting property is 30% of AGI, adjustable gross income. Not getting into that, but let's say you want to stay in with that 30% for gifting appreciated property. Now, cash is 50% of AGI. It simply means that whatever you've given to them, you can deduct up to 50% of it against tax. So if that were the case, you may want to use that deduction still, but also to potentially help you do a Roth conversion. So there may be appreciated assets that you're not really using. You're not really using, and you don't care about getting rid of it. Maybe it's an old tractor sitting in the barn. Thank you very much. That was a conversation yesterday.
Appreciated?
Well, it may not be appreciated, but and maybe he or she doesn't appreciate it, but they want to get rid of it to use it as a deduction. Given that it's a 60/30, I think it is, that really fun John Deere with about 200 horsepower made back in the day. Anyway, if it's an extremely valuable tractor, then the value of it may be worth gifting as a part of your overall strategy so that you can use that as a deduction. Whatever piece of property that might be, it's amazing what you can donate to these organizations and or to the donor advised fund, and then it can be liquidated within. Okay? So the donor advised fund is a charitable investment account. You contribute money or other assets such as stocks, mutual funds, ETFs, or even certain private assets to a charitable organization that manages the fund. Now, it could be an organization. It could be a company like Fidelity. It doesn't really matter in terms of that because they all qualify, or you want to make certain that they do, so that you can deduct that amount that went in. So the short of it is you get to deduct the full amount that went in from an appreciated asset or from an asset period that you don't want to liquidate in this case, and gift it to that organization or organizations over a period of time, or quickly if you like too, and get that deduction and potentially leverage it to do other things you might want to do, not only to help that organization, but potentially do a Roth conversion or complete other financial transactions in your interest.
So you have, let's say, $50,000 as an example.
Right.
You put it into a DAF, a donor-advised fund.
Yes.
And shifting it in there, you don't have to pay any tax for that, right?
Correct. You don't pay the tax on liquidation when it's in the DAF, the donor advised fund. And so then that cash you can use to reinvest. You can reinvest it if you want to, or leave it invested in that investment, if you will, and periodically gift to that organization or organizations that are your favorite charities.
So you don't have to give it away all at once.
Correct.
You can do it over years.
Yes. So whether it's Father Fred, single moms, the library, whatever it is, as long as they're a 501c3 organization, dude, you are ready to rock and roll.
And that can be a nice boon as well if it's a highly appreciated individual stock position, because once it's in the donor advised fund, you can reallocate it. Now, of course, after it goes to the donor advised fund, you can never get any of that money back. But as far as maybe reallocating the portfolio, even though some of it you don't own anymore, it can really help you with that part too.
Mm-hmm. Other benefits, simplified record keeping. Instead of tracking receipts from multiple charities, you receive consolidated records from the DAF provider. So it may be a way for you to say, let's just put our funds that we normally want to give into that donor advised fund.
Bring some order to the chaos and have
Some
everything in
order.
one place.
Right. And if your adjusted gross income is low, it might be a great year to start kicking off your Roth conversion strategy as well.
Ooh.
Order in the court. Then family legacy planning. You can involve your children or future generations in charitable decisions. Now that's radical. You may not want them involved. I get that as well. We've got enough trouble already, but whatever it might be, if you want to involve them in that conversation, it could be really cool. Why wouldn't they want to have some input, potentially? Yes? Yes, yes. The fund can continue supporting causes important to your family long after you're gone. If you do go somewhere. Things to keep in mind: once you contribute assets, as Nathan said, you can't take them back. You can't change your mind about taking them back. The sponsoring charity has final authority over grants if it's a sponsoring charity that sponsors that DAF. Most DF providers charge administrative fees. It's going to be in the range of 1/4 to 0.5% or so, given the day of the week. Okay? So the benefits there, it's interesting now, as opposed to a QCD. The QCDs, Qualified Charitable Distributions, have to start, it can only start rather, anytime after age 70 and a half. That's the only age now that is left from that previous RMD age so many years ago. So many. So the QCD at age 70 and a half, well, why do I want to do it early? I don't have to take my RMD until I'm 73. My required minimum distribution, he says. Well, in case you want to move that money down a bit, I'm sorry, it's too much.
Or
Who
if it's a
says
charity
that?
you already
Some
support.
do.
Yeah.
If there's a charity you want to support, but you don't want to write a check, you want it to go direct from your IRA, less pain.
It's the most tax efficient way to give to charity once you're 70 and a half, taking that money from the IRA and giving it directly to the charity.
What did you say? It's the most efficient way?
Tax efficient way.
Yeah. There's the pièce de résistance.
So what if you are certain means and you can write a check for $10,000 to your favorite charity? If you do that out of your liquid funds, you get a tax deduction, right? If you're itemizing?
If you're itemizing.
If you're
you
itemizing,
write the
right.
check. But
if you decide, compare that with taking a QCD from your retirement money and direct you don't itemize that. You don't get a deduction, but you don't get tax. So what's the comparison on that?
The comparison is it's not nearly as complex, and most likely it's still not going to cost you as much, because there are certain items of tax where that might be included, perhaps if you were writing a check, and it's so much simpler to just have it go direct to the charity or charities of your choice. 1, 2, 3, 4, 5, however many you like.
Because that dollar bill that you earned, that dollar bill has not gone, if it goes into your checking account or your investment account, you have taxes taken out of that because it either came from your income or your earnings. So that dollar is reduced versus that dollar is not taxed when you put it in your 401k or your IRA. And if you're donating from your IRA, that full dollar is going to the charity. So it's a dollar that you earned and full power of the dollar to the charity instead of a reduced amount. That's sort of the way I like to look at it.
You know, it's almost like Monopoly. You get to go right past go. You still get the $200, but you just blow right on by it, you know?
Directly to jail, right? Oh, wait.
Well, no, not that one.
Question on the DAF.
Yeah.
Donor advised funds. So the money that you put into that account comes from, say, assets like a retirement account, right? 401k? No, it does not come from
outside of a retirement account.
Outside of a retirement, okay.
So for someone who owns a stock that's appreciated over the years and has had significant appreciation, they might need the dividend or use the dividend, or they may not. So it just depends on the asset itself, but if it's highly appreciated, that can be some of the best money to gift to that donor advised fund, depending on your overall income and other tax qualifications. It may be a fantastic asset to gift.
And the money, while it's in that account, grows.
It could grow as long as it grows.
Right.
As long as the asset itself is growing in value, it could. But the nice thing is that none of that growth is taxable, and you can still benefit that charity with the proceeds later, if you like. Okay?
Okay, thank you.
Good questions there, Ron, and clarifications. Thank you. Now, Heidi is talking about themes for the second half of 26, because we're almost in July, you know.
Right.
The 7th month of the year. So tell us, what's going on?
Well, this has come to my attention with some of the discussions we've been having in the office about the resilience of the market in the first half of the year. We had lows in March. The market had declined with the commencement of the struggle in Iran. And we've seen the market come back to that, to record highs from that situation.
Can I say, as we sit here on Thursday, June 24th at 10:35, the Dow Jones is up 754 points today.
Don't
That's
jinx
a little,
it, Ron.
yeah.
What's that?
That's a little
Don't
bit of
jinx it.
resilience there. So
Yeah,
what's
it's at an all-time high right now, 52.6 in essence, yeah.
So this, of course, makes you ask, well, what's the underlying story here? Why is this happening? So I found an article by Capital Group that addressed some of that, and they're talking about what to look for in the second half of 2026. But this is some of the things that people are already seeing and the resilience we're seeing in the market. So why has the market shown us such strength? And the article that they have written at Capital Group, they say that corporate earnings are strong, and that is a building blocks for some of this resilience. And of course, AI, which we have been talking about for months and years on the show, is one of the reasons for this. It's like a relentless force out there that is moving the market forward because there is such aggressive spending by technology companies, and that turns into revenue and earnings growth for those companies that they're working with to build out that AI infrastructure. So banks are experiencing better returns than in the far past because of the interest rates staying where they are. We also have healthcare, which is benefiting from AI with technologies and new drugs and new ways to discover illnesses and different types of healthcare issues. We also have higher oil prices recently, which has helped the oil companies and their financial structure. So they note that earnings estimates for emerging markets are where they are looking now. And emerging markets are expected, the revenue is expected to soar 49.2%, which is sort of a crazy number to be an estimate for those emerging markets. And just to remind you what the emerging markets are, an economy that's an emerging economy is a developing nation that is actively transitioning towards a developed market. And this means they're going through rapid industrialization, they have higher GDP numbers, and they're starting to integrate with the global economy. So they're moving towards market maturity and regulatory efficiency. They're moving that way. So what are some of the countries that we would think of when we're talking about emerging markets? We would say Brazil. There's Mexico, India, Indonesia. That's just to name a few. These are the kinds of countries that we're talking about and the companies that are in those countries that we are looking for when we talk about emerging markets.
What's interesting is it points to the importance of diversification, because what was interesting so far this year, the best performing sectors thus far this year are the international sector in these own developing markets. So they're undervalued in terms of price compared to the United States as well. Now, they're always going to correct. There is no panacea, if you will, but it is a great way to diversify. It could be, if you're in the right risk tolerance, we'll just leave it at that, a great way to diversify your holdings to get returns from other sectors or other areas of the world using good money managers.
Mm-hmm. Speaking of correcting, I said Thursday, June 24th earlier, Thursday, June 25th. An alert listener has filled me in on this, so apologies for that.
They're keeping you honest, Ron.
Thank you.
That's right.
They're always listening, which is good. It's
They
great.
are. Yes, thank goodness for that.
So we were talking about AI and the infrastructure and the related products. They are estimating that amount could be 30 trillion over the next decade.
Sorry, what amount? Say that again.
30 trillion.
What could be 30 trillion? I lost the
global investment in AI infrastructure and AI related products. And that's why we call it a relentless force or a driving part of the market, because that's a lot.
It is.
A lot of investment. All right. So let's talk about looking beyond the U.S. borders. So we have talked on the show of our Magnificent Seven. We call it the technology top 7 companies that are in the S&P 500. But they started talking about what they call the emergent 7. So these are the 7 companies in those emerging market countries that they feel are the drivers of some of the international or emerging markets. Now, one way that they look at these is through an index, which is a benchmark that you can use to see how some of these foreign markets are doing. And that we call the MASCI, but its real name, Dennis, is not MASCI. It's the...
Well, what it stands for.
Right.
Yeah. The Morgan Stanley...
Capital International.
Morgan Stanley Capital International. It took me a moment as well. So, yeah, that's another index. You would call it maybe even similar to the S&P 500, but it's an index of international companies put together originally by Morgan Stanley. Yes, thank you.
So they just remark in this article that these companies may have smaller capitalization and lower valuations than many of the Magnificent Seven, but they are generating earnings growth that is expected to exceed the S&P 500.
So they're trading at prices in some situations below that of the United States top 7, Google, Apple, NVIDIA, those kinds of companies, and yet they have a growth rate that this article says is greater than what we're seeing in the United States from these self-same companies. Now, one of those is Taiwan Semiconductor.
Exactly.
They're a major chip maker worldwide. They're the only ones that have the ability to make chips in the way that they do. The most advanced chips in the world come from Taiwan Semiconductor. So these are not, lightweights in terms of what it is that they're producing and or their industrial might, if you will.
All right. And so the third thing we should look at as we're looking towards the second half of 2026 is what they call the physical economy. And the physical economy are things like steel, copper, heavy construction services, power generation equipment. Because of the build out and the investment in AI, these physical things are being increasing demand for those kind of products to be able to accomplish all of that AI infrastructure. For instance, they mention that sales in Caterpillar's construction division jumped 38% in the first quarter. And then that the company also reported an order backlog of $62.7 billion.
Okay, hang on. Now, when Heidi was reviewing the information, we all normally go before the radio show, that number blew me away. So, a 38% increase in construction demand?
Yes.
Or what was the number again?
Sales.
In sales.
Of construction division products.
In the first quarter. Mm-hmm. So that Caterpillar D11, sometimes you want to see a fun piece of equipment, Ron. No. Check that out on YouTube. It's a monster. It's the biggest cat that they build.
It's a
biggest bulldozer is 250,000 pounds with over 900 horsepowers. Not bad.
You see those giant dump trucks, too? I mean,
just incredible.
Yeah.
Incredible. The blade on that thing is taller than a man. You see a guy there, there's a picture online, and they're standing in front of it. It's just humongous how much dirt that can push. So anyway, I digress. Go ahead, Heidi.
All right. And a few other mentions worth going over in this article are they saying look for attractive opportunities in other areas that are unlikely to be impacted by or disrupted really by AI. And they mention things like cruise lines. Cruise lines, people like cruises. They're going to go on cruises. It's for the experience. It's not really AI. And they also talk about jet engines and aerospace type companies, how strong these will be. As we get out of this conflict in Iran, we will need to replace equipment. And other countries in Europe are increasing their budgets for defense. And so we will see strength in that market as well. So look for these sectors because you always want to keep in mind there's always risk out there. There's energy prices and elevated inflation, and some sectors have very high valuations. So there's always risk out there. So you want to be very circumspect about where you're putting your money and look over what are your goals and what are you trying to accomplish and where do you think that the strengths are going to be in the next half of the year.
And or you and your advisor, given the information that they can bring, how can you further diversify and thus give yourself more potential for the future? We need a break here, Ron.
Yeah, one text, somebody said, sure. Thank you, Mr. Prout, for July 4th special program. Thanking you in advance before they've even heard it.
Got a lot to live up to now.
You are welcome. It's a joy. We got together with Ron earlier this week, and we're talking through the details of that. So we're excited to bring it, and you are welcome. So next, Nathan, the Trump account contributions. Tell us, sir.
Yeah, so I'll just hit a couple of highlights here. So, of course, with Trump accounts for anyone born between 2025 and 28, a one-time $1,000 seed contribution from the federal government will be made to that account.
If you open that account.
If you open it, by the way. Yeah. So contributions by individuals, such as parents or grandparents, on behalf of a child, for calendar years before the child turns 18, cannot exceed $5,000, and that will be indexed for inflation starting in 2028.
So what that means is they can contribute up to $5,000 per year for that child for 18 years running.
From all sources.
Right.
From all sources.
From all sources, yep.
Okay, just to keep it within the rules here.
Yeah, but it's sort of a nice thing because you don't have to worry about that child having employment income before contributing to essentially what will be mostly treated as an IRA by the time the child is 18. Let's see here. Another one that I wanted to highlight, and this is a new development. So if the $5,000 annual contribution limit is exceeded, so if you go over that, the excess contribution plus the earnings from that contribution must be withdrawn. So the excess contribution itself is not taxable, and this is recent guidance that came out on this. But the earnings on that excess contribution are taxed at a 100% rate. So very important to not over contribute to the account in any given year.
So that means like you don't get any earnings.
Correct. Well, on that
amount.
excess amount. Yep.
Yeah.
If mom and dad put in 5,000 and grandma didn't know it and she put in $5,000, they're 5,000 over.
There's a problem.
They've got to take out grandma's 5,000.
Right.
But how soon is that executed? There can't be much earnings on that in a short amount of time, can there?
Well, how long until you notice is the
that's-
real question.
Yeah,
Yeah.
hopefully right away.
Yeah, so stay
Hopefully
within
it's
the
not
rules.
10 years later.
You need a quarterback to make sure that doesn't happen there.
Well, and the
that's right.
responsibility for keeping track of all of those contributions will fall on the account custodian. So if you've opened a Trump account, I believe they've just started to notify you of who your custodian will be, and they have given instructions on how to fully open that account with the chosen custodian.
And
But
it's
in
an
coming
IRS
years,
form. It's
yeah.
an IRS form. What is the number of that dude?
Actually, you can do it all online through trumpaccounts.gov.
And
but
it's 4547.
There it is. Yep, 4547.
it's a weird form number.
I don't know where they got that
By the
from.
way, what are the dollars we're talking about here? Let's talk about real stuff, okay? Yeah, I thought this was interesting. I stole your
Yeah,
calculator
you
here.
brought your calculator. Oh wait,
No,
that's
I
mine.
stole yours.
Yeah.
Yes, indeed. So $5,000 a year for 18 years is how much? What's the nut, if you will?
90 grand, right?
5 times 18 is 90. Yep.
Yeah.
So $90,000 over a 18-year period, growing at 8%. Now we're making certainly an assumption there. 8%.
Well, and there are restrictions on what you can invest in within the Trump account. So, it has to most likely be a fund tracking the S&P 500 or
Low-cost
something like
mutual
that.
funds or ETFs that
Yep.
track the S&P 500 index.
Yep.
So 8% historically is a pretty conservative estimate. So I just ran that for up to 18 with no further contributions after that point, from 18 for 40 more years. So to that person's age 58 rather. Any guesses on what that's worth? At that continuing 8% with no further contributions. $90,000 contributed, over that 18-year period. Any guesses on the future value? It's a lot. It's over $1 million.
$1 million. Let's see. That says on the calculator
No.
what's that say? 7?
7.
$7.1 million.
Yep.
Not bad.
So Junior retires at 58 with $7 million.
$7 million.
If his family contributes the max $5,000 a year for 18 years.
Mommy, I always knew I was the favorite.
Well, and attempting to not confuse the Trump accounts, but there is a basis assuming that those contributions were made from a parent or a grandparent. So workplaces can contribute to these accounts as well.
Wow.
But assuming the contributions came from a parent or grandparent, they're treating those dollars as after tax. So that if you end up contributing $90,000 for those 18 years, when the child turns 18, you can convert that account to a Roth account, and they won't tax you on the basis of that account. They would tax you on the earnings still for that Roth conversion.
The child is taxed at that rate.
Depending if they still live with you, it could flow into the kiddie tax. So depending on your situation, it could end up still being the parents basically that get taxed for that. But
It could be contributed over a number of years, especially if they're just getting started and on their own. They're paying it at their tax bracket.
yeah, but if you did that full conversion at 18 and then it grew into a $7 million Roth account,
Tax-free account.
it's pretty crazy.
Let your child grow to age 18, kick them out of the house, and then they can pay it at their tax rate.
There's all
build an
sorts of
in-law
different
suite.
strategies.
Charge them interest on the
Sorry, you're on
$5,000
your own.
initially.
Okay, so stats next. Do we have time for stats here, Ron? What do we
We
looking
have
at?
about 2.5 minutes.
Beautiful.
Okay,
Beth, please.
so home insurance has climbed 46.8% since 2020.
The cost for home insurance? Is that what
Yes,
you're saying? Okay.
yes. A study by the Treasury's Federal Insurance Office showed that from 2018 to 2022, premiums rose 8.7% faster than inflation. The typical policy now runs about $2,300 a year. And Insurify projects that the average home insurance bill will rise another 4% this year after a 12% jump in 2025.
Ouch.
So that is another hidden cost or addition to your bill in home ownership.
All right.
And
We got time for another one, I think, if you got it.
let's see, I did pull some ones kind of as a segue into Nathan's thing about 1.4 million children who enrolled in the Trump accounts qualify for the $1,000 Treasury contribution.
How many?
1.4 million. That's reported so far.
Okay.
I think about 6 million children have enrolled in it. So that 1.4 qualify for it. And nearly 24 state governors have formally committed to integrating the accounts, with some offering state-level deposits for local children.
So 6 million have already signed up.
Yes.
That's
that was the last
amazing.
count.
I didn't
know.
realize that. And about 1.4 qualify. One of our grandchildren does as well.
Mm-hmm.
Yep.
My granddaughter. Yeah, they opened it.
My
for her as
granddaughter,
well.
too.
So.
Wait,
That's
you
right,
say
and yours
1.4 million
right.
qualify, but 6
Qualify.
million already signed up.
Yeah, so maybe that's just processing, but
Okay.
as of right now, it's 1.4. So it's quite
So
a
cool.
number. It is.
That's
it's
great.
really a cool gift
Yeah, it is.
to give.
All right, well, that'll wrap up New Retirement Radio with Prout Financial Design for June 25th and repeating on Saturday, the 27th. Welcome. Dennis Prout, along with Heidi Cartwright, Nathan Prout, and Beth Shire. Thank you all.
Thank you, Ron.
Thanks,
Thanks,
Ron.
Ron.